What is a trust account, or how do you explain the what is a trust account and what is not? The trust account is a special type of bank account that is there to ensure payment. So the payment, you're going to receive payment in advance from the client, but that money is not going to be yours yet. So think about the trust account as the place where money for work that hasn't been performed is going to land. So to ensure payment, you're taking the money out of the client in advance, but it cannot go into your operating account or to your business account because you haven't done the work. You haven't earned it yet. So what happens is that the money go to the trust, and then as progress is made, either by hourly rates, either by billable milestones, or by stages that are agreed on the contract with clients, you're going to start billing that trust account, and then you can move the funds from trust to your operating business bank account. Okay, so operating account, you're operating your main business account. It's for money from work that has already been performed, and trust is for money. And in trust, you're going to put money for work that is yet to be completed. Now, a very important aspect of working with trust accounts is the trust liability account, which means in a normal scenario where you complete work and you bill the client, you will receive the money and into your operating business bank account. And in your account, you will just credit revenue, the revenue account, right? So since it's not revenue yet, you haven't earned it yet, but you have to record it somewhere. So the journal entry matches, right? So what you do is that you increase the trust bank account, which is an asset, a current asset account, and you're going to credit. Well, I said increase. I meant to say debit the trust bank account, and you're going to credit or use a trust liability account. So it balances on each side on the balance sheet. And whenever you bill the client, either for a part of the work or for the entire project, and you move the money from trust to operating, you're going to credit the bank account because it's reducing. You're reducing the money on the trust account for that client, and you're going to debit the trust account. So that trust account gets canceled. Basically, it you're just doing this. You're switching it again. So um, that is how the workflow of trust accounting works. And when you do on a monthly basis your bank reconciliations and your bank matches, what you have to do with the trust account is basically the trust account is all the money from your clients is going to land there. So it's like having a little notebook and you're writing down how much each person has contributed, and the total sum of what each person has contributed, it should match the sum of the total money into the trust account. So if you have three clients, client A gave you $500, client B gave you $200, and client three gave you $300. Um, the total balance in the trust account should be $1,000. If it's not, well, you have to dig into what it is. Maybe it's an unclear check, maybe it's a voided check, or a transfer in transit, or a deposit in transit, or it's the interest that you earn in that trust account, because those accounts are usually interest bearing accounts. So those are the dynamics or the thing that you have to consider when you are closing the month and on your accounting and you are using trust accounts. And that's pretty much it. What you do with those interests that you earn is not your bank account, it's not your money, it's a little bit more niche, but we will leave that for another video. Okay.